Hey there, and welcome back to Retire Your Way with ILG Financial. My name is Chase Lopez. This is Dave Lopez, and we're both investment advisor representatives at ILG Financial. And today we're going to talk about the Backdoor Roth IRA.
Backdoor Roth.
Yeah, and if you have followed articles lately, there's a lot of big talk around the Backdoor Roth and how it can be used. But we like to start with what is a Roth, right? And we'll brief, if you've seen our other videos, we have a video specifically about a Roth IRA. But just the brief highlights are, it's a retirement account. But you, instead of like a traditional IRA where you don't pay the taxes and the money goes into the account, with the Roth, you pay the taxes before the money goes into the account. And as the account grows, it grows tax-free. When you take the money out, now you're taking the money out of a tax-free account. So that's big picture what a Roth IRA is. Why don't you let us know how we incorporate the Backdoor Roth with that?
Yeah, so the challenge, which is when you hear that, the first thought for many people would be, if you're thinking taxes are going up,
right,
would be, man, why don't I put all my money into a Roth?
Right.
Right? I will, especially money that's taxed already.
Right.
I'll just put the money in the Roth and never pay taxes again.
Right.
Well, it's a great idea. So much so that the government says you can't do it,
right,
because we want tax dollars, right? So what they've said is we're going to limit how much you can put into a Roth.
Right.
And it's limited currently to $6,000 a year. If you're over 50, you get a catch-up of, is it 1,000?
1,000,
yeah,
correct,
so you could, if you're over 50, you could put up to 7,000. Now that's money you've earned. You have to have earned money. You can't be unemployed, or
right,
you have to have earned at least $6,000 or $7,000.
Right.
And that is instead of a regular IRA.
Right.
And there's also limitations if you're using a company 401k based on your income. You can't do both. You might be able to do both if your income's low enough.
Right.
But if your income's over a certain level, you can do the 401k, but not the Roth
IRA.
Okay. So you're limited to, one of the disadvantages here is we're limited. Right. So what's a backdoor Roth?
Yep.
Boy, that took a while to get there, so I apologize. A backdoor Roth is if you, because of income, you can't contribute to a Roth. And what are those income numbers?
Yeah, so for a married couple filing jointly, it starts at a modified adjusted gross income of $204,000 is when they start phasing out you not being able to contribute to a Roth. And once you get up to $214,000 for a married couple filing jointly, you're not allowed to contribute to a Roth. For a single person, it starts at $129,000 is when they phase out you being able to put into the Roth, and by $144,000 of modified adjusted gross income, you can no longer
can't do it at all.
Can't do it at all.
So this is for this backdoor Roth is for people that earn above those limits.
Right.
They want to take advantage of a Roth, but now they don't qualify to it. So
right,
they say, hey, I want to participate. So how do you do it? You do it with what's called a backdoor Roth, and that would be, since you can't do it into a Roth IRA, you can still put your money, $6,000
yes,
or $7,000 if you're 50 or over, into a traditional IRA. Now,
correct,
a traditional IRA, which you know from our previous videos, you get a tax deduction when the money goes in, but
right,
unlike the Roth, when it comes out, it's taxable.
correct.
So what the trick is with a backdoor Roth is you put that 6,000 or 7. It doesn't have to be the total. Anything
right,
you want to put, just not over that. 6,000. If you're over 50, let's talk about that for today.
Yeah.
$7,000, you're over 50, goes into it for the year.
Right.
But you actually document that as after-tax dollars, meaning you don't take the deduction as
right,
it goes in. Now that's key.
That is.
Because now you've paid the tax on the $7,000, it goes in, but that also means the $7,000 when it comes out of your IRA is not taxable. Any gains would be, right, Chase? But not the $7,000. Backdoor Roth is we put the money in after tax dollars, $7,000 goes into your IRA, then we immediately roll it to your Roth.
Right.
And since we immediately did it, there are no gains, which means you've already paid the taxes, and we take advantage of the Roth. And all we've done is added a step. Instead of opening a Roth and putting $7,000 in, we opened an IRA, put $7,000 in, immediately transferred it to the Roth.
Yeah, and why that's so important for folks is when that money gets into the Roth, right, now it's growing tax-free.
That's right.
Which is much different than an IRA or even a regular account. If you were to have, just a regular brokerage account, on a regular brokerage account, you're still going to pay capital gains tax. So really, that's the big use case for doing this backdoor Roth. Wouldn't you agree?
Yeah, it is. Now there's some limitations to it, right? So for example, if you already have a 401k and you're contributing, you may not be eligible even for an IRA. Right. Another disadvantage is you want to be very careful you're working with somebody, a firm that knows what they're doing, whether it's an accountant or your financial advisory firm, because if you have other IRAs, right, and you put money into your IRA, even a new one or an existing one, and then you want to turn around and put that $7,000 in a Roth, the IRS says, no, you can't necessarily count that 7. We're going to look at the whole pool of your IRA. So let me give you an example very simply. Let's say Chase has $100,000, Chase, you've got in your IRA, and now you take $7,000 after tax, you put it in there, we're up to $107,000. Right. You immediately write a check or transfer $7,000 into your Roth. Right? And you said, well, that's fine. Now I put 7. The IRS says, nope. What happens is you've got $107,000 in there. You can't just decide the $7,000 that went to the Roth is the new money. $7,000 is now, oh goodness, I didn't do my math. It's 10% roughly. Yeah. Right? 10% of 107,000 would be
that would be
10,700, right?
Yeah.
So really, they would say it's going to be only a small percentage of that 7,000 going into your Roth can be counted as the new money. Right. The rest is going to be counted as other money with gains that's taxable.
Right. So they prorated against what your account value already was previously.
I probably made that more confusing than it is. The easy way to remember that is you just have to be careful how you do this.
Exactly.
Get with a professional to make sure that it's done correctly.
Correct.
Right. Another disadvantage with a Roth when you're doing it this way, if you're rolling it, is most people know, some don't, right, that one of the challenges with a Roth is that when you put it in, you can't touch the money without a federal penalty unless you've left it there 5 years. And that's even if you're 59 and a half or 60 years old. And that's from the date you do your first Roth. Right. So you can do multiple contributions over your lifetime, and that's fine. They just look back at when you opened your first Roth. So no problem. Here's the trick. If you do a conversion, which is part of the backdoor Roth, from an IRA to a Roth, that bucket that you converted has its own 5-year window. So anybody doing any Roth conversions, not just backdoor Roths, a lot of folks we work with in retirement are trying to roll IRA money over to their roll IRA money over to their Roth. You need to be aware that starts for that bucket, that $6,000 you rolled over, that's a new 5-year window. So you want to be really on top of what happens, how you're tracking that money, Chase.
Right, so you would certainly want to, at least for that money that you're rolling into the Roth, you would want to be comfortable, I would say, leaving it there for at least 5 years. Would that be fair?
And you want to make sure that there's a mechanism in place to track it when you start pulling this money out. So if the IRS starts checking, you can document exactly what went in when and that you waited your 5 years. Okay, the last thing we'll let go, I want to mention briefly, because it comes up, is people say, well, I've heard of it, Dave, a backdoor Roth. But someone else said it better than that. I can do a mega backdoor Roth. What in the world is a mega backdoor Roth? Well, it's clear. It's a backdoor Roth, but just more. So how can I do more than the $7,000? Well, if you're lucky enough to have a 401k, you may know that you're not limited, even though you can only put, if you're 50 or older, $7,000 in your IRA, you can put more into a 401k. So a 401k, you can put as much as $20,500.
Correct, and that's if you're under 50.
If you're over 50, you get a catch-up of $6,500. So that's $27,000 into a 401k versus $7,000 in an IRA. That's also, by the way, why if you're contributing to a retirement account, there's income levels where you could not necessarily do both. Right. If you have low on income, you could contribute to both. $7,000 in the IRA, $27,000 in the 401k. But as your income levels get higher, you lose the IRA contribution ability. But imagine what we just explained with a backdoor Roth. You can do the same thing if your 401k allows. You could put up to $27,000 in your 401k and then immediately do a mega backdoor Roth and put the $27,000 into your 401k, Roth 401k. So that's available. Again, you need to get with your accountant or your financial professional. Make sure you dot your I's, cross your T's, and keep your data so you know how to do this.
Yeah, and specifically with that, with the 401k, the mega backdoor Roth you were referring to, it's important for all the people out there to know every 401k plan is different depending on the company that provides it, depending on the company that you work for. So it's very important to get with them also to see, hey, is this even an option with our current plan?
That surprises people.
It does.
Right?
It does.
401k is literally called an employer plan, meaning each employer writes his own rules.
Exactly.
So your past employer may have done it one way, your friend's employer may have done it one way, and your new one won't allow it.
Yep.
All right. So just get with your HR department, find out if it's available, and then talk to your financial professional.
Yeah, so if you like the video today and want to continue to see videos from us moving forward, go ahead and hit the like or subscribe button or even the bell there at the bottom, and we'll talk to you soon.
Talk to you soon.